Recently, I made a video about FINTRAC and the $10,000 cash reporting rule in Canada. That video has been seen by tens of thousands of Canadians, and the number one comment I received was some version of the same question: what happens next? Well, on March 26th, 2026, the federal government gave Royal Assent to legislation that changed 6 things about how Canada handles your cash, and every single one of them made it worse. In this video, I am going to walk you through all 6 changes. I am going to show you how a $1,000 fine became a $4 million fine overnight. I am going to explain why Canada is now proposing something that not even the United States has done, and I am going to give you an updated list of exactly what to do to protect yourself. Let me start with the change that took effect on March 26th, 2026, because this is not a proposal, this is law. On that date, the Budget 2025 Implementation Act received Royal Assent. Buried inside that legislation were amendments to the Proceeds of Crime, Money Laundering, and Terrorist Financing Act, the law that governs FINTRAC. Those amendments restructured the entire penalty framework for FINTRAC violations, and the numbers are not subtle. Under the old system, if you were a business that failed to file a report with FINTRAC, the maximum fine for a minor violation was $1,000. That is now $40,000. A serious violation. Used to cap at $100,000, now caps at $4 million. And a very serious violation used to be $500,000. That ceiling is now $20 million. That is a 40 times increase across the board. Not 10%, not double, 40 times. And there is a cumulative cap, $20 million per entity, or 3% of the organization's gross global revenue. Whichever is higher, for a major Canadian bank, that 3% clause could mean a penalty ceiling exceeding $1 billion. Now, I want to be clear about something. These are maximum penalties. Not every violation will trigger the maximum, but the framework itself tells you exactly where Ottawa's priorities are heading. The era of small fines and warning letters is over, and this brings me to the second change, because the penalty increase was only one part of what happened on March 26th. In my first video, I talked about Bill C-2, the Strong Borders Act. At the time, it had just been introduced in Parliament. Today, I want to update you on where it stands and why this bill is the most significant threat to how Canadians use cash in this country's history. Here is what you need to understand about the difference between what the United States does and what Canada is proposing. In the United States, if you deposit $10,000 or more in cash, your bank files a report with FinCEN. That is a reporting requirement. The transaction itself is legal. The report is mandatory. What Canada is proposing under Bill C-2 is fundamentally different. Bill C-2 would make it a criminal offense to accept a cash payment of $10,000 or more. Not report it, accept it. The act of receiving the money would itself be illegal. Let me walk you through who this affects. Every business in Canada, every charity and nonprofit, every private transaction above the threshold. If a contractor pays you in cash for a renovation, if you sell a vehicle privately and the buyer pays in cash, if a customer pays a restaurant bill that pushes the day's total above $10,000 under Bill C-2, accepting that cash would be a criminal act. And here's one of the details that did not get enough attention. The bill includes night deposits. If you run a business that collects cash throughout the day and makes a single end-of-day bank deposit that totals $10,000 or more, that deposit itself could be prohibited. You would need to split your deposits across multiple days, storing cash on your premises overnight, which increases your risk of robbery. There's a restaurant owner in Montreal, Vince Morena. He runs St. Viateur Bagel, one of the most well-known establishments in the city, cash-only operation. He described exactly this problem. A $20,000 weekend of cash receipts that he currently deposits in one trip to the bank on Monday morning, Under Bill C2, he would need to split that across an entire week. And every night, the cash sits in his shop. His employees and his business are at risk. Now, as of the date I am recording this, Bill C2 has not become law. The criminal cash ban was removed from Bill C12, which is the expedited version that did receive Royal Assent on March 26th. But the cash ban remains active in Bill C2, which is still before Parliament. What that tells you is that the government separated out the parts it could pass quickly. The penalty increases from the part that is more controversial, the cash ban, but it did not abandon the cash ban. It is still on the table. And as the Justice Center for Constitutional Freedoms pointed out, once 10,000 is criminalized, it becomes very easy for a future government to lower the threshold to 5,000, then to 1,000. The precedent is the danger. The third change happened on October 1st, 2025, and most Canadians missed it entirely. On that date, FINTRAC expanded the list of businesses required to register as reporting entities. Now, if you watched my first video, you know that banks, credit unions, casinos, real estate agents, and money services businesses were already required to file reports with FINTRAC. That has been the case for years. What changed on October 1st is that entirely new categories of businesses were pulled into the reporting network. Check cashing businesses now fall under FINTRAC, and here's the detail that matters. For check cashers, the identity verification threshold is not $10,000, it is $3,000. Any transaction above $3,000 at a check cashing outlet now requires identity verification and creates a record that feeds into FINTRAC's system. Private ATM operators. If a company links a private ATM, the kind you see at corner stores, gas stations, bars, to a payment network, that company must now register as a money services business. Full compliance program, full reporting obligations, full record keeping. Factoring companies. These are businesses that buy accounts receivable from other businesses. They handle large volumes of transactions, often in cash-intensive industries. Now they report to FINTRAC. Title insurers, financing, and leasing companies. What this means in plain terms is that the places Canadians previously used for cash transactions with relatively little scrutiny, payday loan centers, check cashers, independent ATMs, now all feed into the same federal surveillance system. The net got wider, and it happened 6 months ago. This is the change that I think most Canadians will find the most disturbing, because it changes the fundamental relationship between you and your bank. In February 2025, the Canadian government launched something called the Integrated Money Laundering Intelligence Partnership, IMLIP. Here is how the system used to work. Your bank sees something it considers suspicious. It files a suspicious transaction report with FINTRAC. FINTRAC analyzes it. If FINTRAC finds a pattern, it shares intelligence with law enforcement or the CRA. That was the flow. Bank to FINTRAC, FINTRAC to police. Here is how it works now. Under IMLIP, Canadian banks can now share your personal financial transaction data directly with each other and directly with law enforcement without going through FINTRAC as an intermediary. And under Section 11.01 of the PCMLTFA, this sharing happens under an approved code of practice, without your knowledge, without your consent, and without any requirement to notify you. Let me put this in concrete terms. If your bank in Toronto flags your account, it can now share that information directly with your mortgage lender, your credit card company, and the RCMP. Simultaneously, before FINTRAC has even reviewed the flag, you will not receive a letter. You will not receive a phone call. Under the tipping off prohibition in the PCMLTFA, your bank is legally prohibited from telling you that any of this happened. This is not a proposed change. IMLIP is operational. The first meeting was February 19th, 2025. The framework is live. The fifth change affects every Canadian who has bought, sold, or traded cryptocurrency in the last year. On January 1st, 2026, Canada implemented the Crypto Asset Reporting Framework, CARF. This is an international standard, but Canada was one of the first countries to put it into force. Here is what it means. Every crypto exchange serving Canadians is now required to track every transaction you make, every buy, every sell, every crypto to crypto swap, every transfer in or out of your wallet. And attached to every single one of those transactions is your full identity, your name, your address, your date of birth, your tax identification number. Starting in 2027, that data will be reported directly to the CRA. The CRA will then cross-reference it against your tax return. If you sold crypto in 2026 and made a capital gain that you did not report, the CRA will know. Not because someone tipped them off, because the exchange handed them a complete record. And here is an additional detail that has not received much attention. In 2026, FINTRAC revoked the registrations of 47 crypto firms operating in Canada. These firms were providing services to Canadians without being properly registered as money services businesses. If you were using one of those platforms, your transactions may have been occurring on an unregistered exchange, which means those transactions may not have been properly reported, which means you may have exposure you do not know about. I have laid out 5 changes, new penalties, a proposed criminal ban, expanded reporting entities, bank-to-bank data sharing, crypto tracking, but none of it matters if it is not enforced. So let me show you what FINTRAC did in 2025. In its 2025 fiscal year, FINTRAC issued approximately $202 million in publicly disclosed penalties against 21 companies. That is 8 times the previous annual record. This is not a gradual increase, this is a step change. FINTRAC went from an agency that issued a few $1 million in fines per year to an agency that issued $200 million in a single year. And the single largest fine tells the story. Cryptomus, a Vancouver-based crypto exchange, $176,960,000, the largest penalty in FINTRAC's history. 2,593 violations, 1,068 suspicious transaction reports that were never filed, over 1,500 crypto transactions above $10,000 that went unreported. KuCoin, 19.6 million, operating in Canada without registering as a money services business. TD Bank, 9.2 million, 20 suspicious transaction reports that should have been filed and were not. RBC, 7.5 million, similar failures. These are not small operators being made examples of. TD and RBC are 2 of the largest financial institutions in the country. When FINTRAC fines a bank $9 million, that is a message to every financial institution in Canada. Compliance is no longer optional. And there is one more piece to this. The federal government announced in Budget 2025 that it is creating a new financial crimes agency, a dedicated enforcement body modeled on the FBI, combining police and civilian investigators whose sole purpose is to investigate and prosecute financial crimes in Canada. FINTRAC collects the intelligence, the CRA audits the taxes, and now a new agency will handle the criminal prosecution. The infrastructure is being built to make enforcement faster, more targeted, and more aggressive than anything Canada has had before. Let me pull this together, because I do not want you to walk away from this video with just fear. I want you to walk away with clarity. Here's the picture as of April 2026. The $10,000 reporting threshold has existed since the year 2000. It has never been adjusted for inflation. In $1970, $10,000 today is worth approximately $1,100. The threshold that was designed to catch serious criminals is now flagging routine transactions by ordinary Canadians. The penalties for failing to comply with that threshold just increased by a factor of 40. That is law. The government is actively debating whether to make it a criminal offense to accept $10,000 in cash. That is not law yet, but it has not been abandoned. Your bank can now share your financial data with other banks and with law enforcement directly without telling you. That is operational. Every crypto transaction you made in 2026 will be reported to the CRA next year. That is in force. And FINTRAC just proved it is willing to issue 9-figure penalties. That is fact. None of this means cash is illegal. None of this means every Canadian is a target, but it does mean the system around your money has changed fundamentally in the span of 12 months. And here is what you should do about it. Step 1, never structure. I said this in my first video, and I will say it again, because it is the single most important rule. If you have $10,000 or more in cash, deposit it in one transaction. Do not split it. Do not spread it across days. Do not try to stay under the threshold. The moment your deposits look like they were designed to avoid the reporting limit, you have a structuring problem. And structuring is a criminal offense, up to 5 years imprisonment and up to $2 million in fines. Step 2, document every cash source above $5,000, not 10, 5. Because the compliance environment has tightened and because suspicious transaction reports have no minimum threshold. If you sell a vehicle for $8,000 in cash, keep the bill of sale. If you receive an inheritance, keep the estate records. If you withdraw your own money from the bank, keep the receipt. The question you are preparing for is, where did this money come from? And the answer needs to be on paper, not in your memory. Step 3, if you run a cash-intensive business, get a compliance review. Now, not next quarter, now. The penalty for a minor compliance failure went from $1,000 to $40,000. The penalty for a serious failure went to $4 million. If your restaurant, your trades business, your market stall does not have proper anti-money laundering procedures, proper record keeping, and proper training for staff, the cost of non-compliance just became existential. Step 4, if you hold crypto, make sure you are using a FINTRAC registered exchange. 47 exchanges had their registrations revoked in 2026. If your exchange is not properly registered, your transactions may not be properly reported, which creates a gap between what the CRA expects to see and what actually happened. Move to a registered platform before the 2027 reporting cycle begins. Step 5, if you have structured transactions in the past, even unknowingly, talk to a lawyer, not an accountant, not the CRA, a criminal or tax lawyer. That conversation is protected by solicitor-client privilege, and I would encourage you to have that conversation sooner rather than later. Because when the new Financial Crimes Agency becomes operational, the government will have a dedicated team whose entire job is to investigate exactly this kind of activity. Here is the bottom line. The rules around your cash changed more in the last 12 months than they did in the previous 20 years. The penalties are higher, the surveillance is wider, the enforcement is real, and the direction is clear. Understand the rules, document your money, and if something in this video made you realize you may have a problem you did not know about, act on it now, not later. If this was useful, subscribe. I cover the CRA rules, the tax laws, and the financial regulations that affect ordinary Canadians. The rules are public. Most people just never get them explained clearly. I am Andrew Graves. I will see you in the next one.